Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. Before we get started, let me remind everybody that trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you decide to trade foreign exchange, carefully consider your investment objectives, your experience level, and your risk tolerance. You can lose all or part of your risk capital in the foreign exchange market, so be aware and be prepared. Speaking of being aware and being prepared, Adam, we have the FOMC coming up, and this is a big risk event for traders. And I know that on our website at ForexLive.com you had a little bit of a dovish comment there. So I thought maybe we'd start off with getting your thoughts and on what you think the FOMC is going to do or say today. Probably not do anything, but it's what they say. And then we'll take a look at some of the technical charts in regard to the currency pair. So go ahead.
Perfect. 30 minutes. 30 minutes now until the decision. So, I'm geared up, excited, and we've got a take on it. We don't want any fence sitting, and I'm not going to sit on the fence on this one. I think the risk is that they take the dovish side, and I think we know that the dollar crowd is very traded, right? The dollar trade is very crowded right now, and the Fed, for me, is not going to remove patient at this point. There's not any clarity in economic data. We just go back to yesterday, durable goods extraordinarily weak for the 5th month in a row, and then consumer confidence at record high, new home sales at the highest since the crisis. So the Fed doesn't have a good idea where the economy is at, and they don't want to signal a rate hike and then have to take it back. So the risk to me is that they get more dovish, and the way they're going to do it isn't by pushing out necessarily commentary, but they can talk about the downside risk to inflation. Number one, that's how they could hurt the U.S. dollar. Number two would be to mention the U.S. dollar. Corporate earnings, if you look at them so far this week, everybody's been mentioning the U.S. dollar and talking about it as a headwind for profitability. That's going to hurt investment. That's going to hurt the economy. It's also going to hurt inflation. So even just a mention, I think, of the U.S. dollar is a reason to sell the U.S. dollar, and I believe that's going to be the trade. What are the charts saying, Greg?
Let me get my euro chart. I might the one thing that in regard to to those comments is it's not necessarily or what I find is that the Fed typically doesn't go into that the idea of the foreign exchange market specifically in the statement, and the other thing is in the corporate profits. But there's definitely reasons for the Fed to be a little bit more cautious. I'm just wondering if it's not going to be until March. But anyway, that's
really, I think, what it's going to come down to. It's probably going to happen either today or it will happen at the next FOMC meeting in March when they start to scale it down, because the market's way ahead of them now in talking about. The June hike is basically priced out of the interest rate market. So, what's the euro chart saying?
All right, let's get into the chart here. I'll have the. There we go. You should see the chart up right now, and what the market set itself up for today was actually very and actually over the last couple of days was a nice little level right here against the 100-hour moving average. That's a blue line in this chart, and so that gives traders a nice little risk-defining level down there to determine either bullish above and bearish below. So Adam, if your idea of more of a dovish idea comes along, we're going to move away from that 100-hour moving average. If they don't have that dovish bias, if they don't talk a lot about the risks, then we could see the market start to move back down below that 100-hour moving average. So from a technical perspective, that's my risk-defining line in the sand, if you will, for the bearish/bullish bias. Move below that level. Look for the market to stay below that level and move down, toward our low levels. If the market moves higher, we have another couple areas that I have of interest. Obviously, we have the high, but before then we have retracement, and this 113.72. We're not that far away from either of these levels, but nevertheless, if we move above, let's say, the 113.72 level, and that level to me has importance because it corresponds with the low price going back to November of 2003, right here on that chart, the 1372 level. And if I go back to the hourly chart again and take a look at what we did over here when the market was moving to the downside, we peaked near that 1372 level there. So we came down on all the ECB, and then we peaked right there and moved to the downside. So it's a level that the market pays attention to. So really close. These are my risk-defining levels. Above this level, below that level, and then we start to look toward the 200-hour moving average, 61.8% retracement, 1539 level. These are all levels going back in time, way back to 2005 and such. And so that's how I'm seeing from a technical perspective. Right now, the market seems to just be setting itself up in a nice, comfortable area where they can define risk above, define risk below, and go with whether it's going to be more bullish or it's going to be more bearish.
I like it. If I'm right and the Fed is a little bit more dovish, we'll see something to the upside. I know notice you have the 200-hour moving average there. If we get up above that, the 61.8%, where do you think we could get to? I mean, what would be a nice target on the upside in euro if that comes to pass?
I have to go back and retrace back to where our old highs and lows were, and looking at the monthly chart once again. Why? Because you have to go back in time, and this is the last time the market traded at these levels. You see these lows right here going back to 2005. Those levels come at the 1639 level. Okay, and then so I've earmarked that level way up here. And note here on the hourly chart what the market did up against that level. We found sellers against it. We moved above it and failed right here, came down. The next day on the ECB day, the market found sellers near that level and moved to the downside. Another level that's important here just off the hourly chart is around this 1539 level, and you can see why here. It's just a level where we found support, and went through. It's kind of a minor level, but that's another level of significance. So we could see ourselves heading back up into this area right here, up let's say above the 1539 level up to about the 1639 level. That's where over time. That's where I think that the euro.
I think if we do get up there. The ECB, they will not be happy, first of all, because to be honest, ECB QE was about weakening the euro. And I think if you're a longer-term dollar bull, anywhere up around 16 is around 116 is a nice level to sell.
Absolutely.
Got some more levels there to sell against. The other chart we've been talking about, it feels like dollar yen's been around 118 forever. Again, I probably like the downside in the dollar here, but looking at the chart, there's been so much consolidation that maybe the go with trade is the trade to go with here again. We're stock, we're hearing a lot of talk about stops below 117, so that's a key level to keep an eye on, and then the 116 below that. When you pull up the dollar yen chart, what do you see?
All right, you're right. The consolidation here in the chart is the obvious thing. Lots of ups and downs, and you could have made a pretty good living selling highs and buying lows in the dollar versus yen over the last few weeks. That's for sure, because there've been these trend moves that are quick and fast and directional, and then they hit a resistance level and they start to come down. Sometimes, in times you get these little failures over here, and they kind of give you this false assurance that we're breaking to the upside. But then what do we run into? We run into these old highs right here, and so the market reverses itself. And as soon as things like this happen, where does the resistance start to pick up again? Right against that level. We did it here yesterday in the trading here. We failed above there, and where did the resistance come back in? Against that old trend line. And so like the euro, we're kind of setting ourselves up with a range. On the downside, you can do the same thing, of course. These little failures, pick it up as support. These failures, pick it up as support. And so technically, again, I'm pretty happy with the way the thing's setting up here. The question is, do we break outside of this box? Are we able to get outside of the range? And the only way that I know how to do it is to follow the steps. Follow the steps. If we're going to go lower, like you think, and we get more of a dovish statement, we'd want to see the price get below our low from yesterday. I mean, it's obvious. We want to see the price get below these levels and this low right here. This is the I think the key levels. Why? Because the last 5 or 6 trading days we've had lows in a range from 117.17 to 117.32. So for me, it's not 117 level. It's getting below the 117.17 level and staying below that area. If it can do that, you have more potential to trend and get outside of this range. And so that's what I'd be looking for, is a break and staying below the 117.17 level on the downside. On the top side, early call here is to get above the 200, get above the 100-hour moving average. These two moving averages are moving together. Stay above that level. We got to get above the trend line. We got to get above this high. We got to get above the 75 and 85 area up here, and then that opens the door to the upside. So it's a classic consolidation into a key event. Will a key event send us outside of our range, or will we stay in that range? You can play it many different ways. You can buy the dip, but make sure that if the market goes outside of that range, that you have your risk defined and limited, because it could start to trend outside of this range if it does break.
That's sort of the trade I like. Maybe selling on an order below 117 and picking it back up at 116 for 100 pips, something like that. And monitoring the headlines on the same time. It's tough to put that order in before the FOMC because you get those whipsaws.
Yeah, I wouldn't suggest that.
You might pick up your order and then it comes right back in a second. But if that would be the way I like it. And just overall, dollar yen, we've seen over the years these wedges on the chart. They break out and they last. And if you look at some of the dailies, I mean, they are absolutely textbook. And even the longer term, that's the hourly. It's starting to wedge really since December. And it's going to go, and today, might be the day you have to be ready, and it goes longer and stronger than people expect. Right. So on the upside, maybe I'm wrong about the Fed being dovish. Maybe they stay hawkish, and it's not unreasonable to talk about 124, 125 because these moves can last. Especially if some of the rumors about the Bank of Japan introducing negative interest rates prove to bear fruit.
Absolutely. And the way that I've always looked at it, Adam, is this, and people out there is that the way you catch a trend is to anticipate a trend. And if you just have that thought in your mind that the market has a potential to trend, why? Because it's non-trending, it's in this consolidation range. You save yourself from selling highs and buying lows when you're not supposed to be doing that. That's where traders, a lot of traders get in trouble. So I think that is another way of saying what you just said. But from a technical perspective and from a mindset perspective, you got to think trend in order to catch trends. So if it's going to go to 124, if it's going to go to 110, you got to have that mindset that is a potential.
All right. So just final thoughts on the Fed. I think going with it is key on whipsaws, potential whipsaws. The Fed has some mixed headlines. I think it might come out on the inflation side or the dollar side, but I really believe the dollar side will overwhelm it if they mention the dollar, and that would be negative almost surely. And then the patient or not being patient, they're going to probably remove the part that explains that patient is the same thing as considerable time. So that might be misinterpreted as being hawkish, and I think there's a chance of a whipsaw there. You always have to watch out for the whipsaws on the Fed. And any final thoughts? Do you want to mention the RBNZ? It's an hour after the Fed as well, so that's another major risk event for traders there.
Right, we do have the RBNZ. No change expected there from a technical perspective. Let me.
Wrote a nice preview. There's a preview at the top of our site, technical preview on Kiwi dollar that Greg did. Very complete. And
right, exactly. I'll also just put up the chart real quickly here. From you know, again, from an hourly perspective, the market's kind of off the lows here. We've been trending to the downside. You know, this upper trend line held like a charm in last night's trade. It was staying right around the 100-hour moving average. You know, this is our low going back number of years. So, you know, break above the trend line, move below the lows. You got to go with it. It's the same old breakout trade.
You get a hawkish RBNZ and a dovish Fed. There's certainly a lot of room to scope for rebound in that there. But we saw yesterday CPI in Australia was on the high side, and you know, the Aussie has really not been so great since then. So, you know, the dollar is strong. It you know, you think it would run out of gas at some point, but it's over when it's over.
Yep. Yep. You got to listen to what the trends are saying, and you know, it's good to have the fundamental perspective and all that goes along with it. But the price movement is going to also tell a key story in trading here today with these key events. So why don't we finish it up there, Adam? I appreciate your thoughts, and appreciate everyone coming in here today for our ForexLive hangout. Good luck with your trading. We have 15 minutes till liftoff, so be careful, but have fun, and make sure you define and limit your risk. That's most important. Take care, everybody. Thanks a lot. Bye-bye, Adam.